It may be surprising to hear that banks often count on consumer inattention and a lack of information to maximize their income. But a little vigilance and knowledge can go a long way, and by staying informed, you can avoid these common pitfalls and keep more of your hard-earned money. Here are the dirty dozen ways you might be leaking money to the banks, and how to avoid it happening in future. Number 1. Balance transfer fees on credit cards. Balance transfer offers can be enticing, promising low or zero interest rates when you move your balance from one card to another, and they are potentially a great way of paying off your credit card debt faster. But here's the catch. Banks often charge a fee for this service, typically 3 to 5% of the transferred amount. This can add up, especially with larger balances. To make this work for you, calculate the fee and compare it with the interest you would have paid on your original card. If the fee is less, it's a good deal. Otherwise, give it a pass. And always read the fine print to understand the duration of the low interest period and what the rate will jump to afterward. Number 2. Overdraft fees. Imagine you're buying coffee, and unbeknownst to you, your account balance is lower than the price of your latte. As a result, you've just incurred an overdraft fee. Banks charge these fees when your account dips below zero. They might frame it as a courtesy of covering your transactions, but these fees can be steep. In the US, overdraft fees can be around $35 per transaction, but you can opt out of overdraft protection services for debit card purchases and ATM withdrawals. This means transactions will simply be declined if you don't have enough funds, saving you from these fees. This actually helps you stay within your budget, since it stops you from spending what you don't have. Additionally, regularly monitoring your account balance can keep you in the clear. Number 3. Minimum balance fees. Banks often set a minimum balance requirement for certain accounts. Falling below this threshold can trigger a fee. It's an easy way for banks to ensure a certain level of deposit in their coffers. But here's how you can play it smart. First, be aware of the minimum balance requirements when you open an account. If you're struggling to maintain the minimum, consider switching to an account type with a lower requirement, or no minimum at all. Some banks even waive the minimum balance fee if you have a monthly direct deposit set up, so that's another avenue to explore. Number 4. Inactivity fees. Your forgotten bank account could be costing you. Some banks charge a fee for accounts that haven't seen any activity for a certain period, typically ranging from 6 to 12 months. This fee is a nudge for customers to either close their accounts or start using them. There are 2 ways to avoid this. One is to simply close any accounts you don't need and have those balances paid back to you. The other way is to keep a small activity in your account. A simple transaction, like a periodic small deposit or withdrawal, can keep your account active. Also, regularly review all your bank accounts, especially if you have multiple accounts, to ensure none are slipping into inactivity. Number 5. Foreign transaction fees. Traveling abroad? Your bank might charge you for purchases made in foreign currencies. These fees typically range from 1 to 3% of the transaction amount, and they can add up quickly without you realizing it. Or banks may tout zero-fee foreign exchange, but then quietly hit you with more expensive exchange rates instead. To outsmart this fee, consider getting a credit or debit card specifically designed for international travel, with no foreign transaction fees. These cards often have much better exchange rates too. Additionally, when given a choice, opt to pay in the local currency instead of your home currency to avoid dynamic currency conversion fees, which can be even higher. Number 6. Paper statement fees. It's a digital world, and many banks strongly encourage online banking and e-statements. So if you can't let go of your preference for paper statements, beware of potential fees. Banks often charge for this somewhat old-school service. It's not just about the cost of paper and postage, it's also a not-so-subtle push towards digital banking, which is much cheaper for banks to manage. However, you can easily avoid this fee by opting for electronic statements and advices. If you're not tech-savvy, consider this a good opportunity to become more comfortable with digital banking. It's secure, convenient, and can save you money. Plus, it's better for the environment. Number 7. Excess transaction fees. Some banks charge fees for excess transactions. Savings accounts in the US, for example, used to have a federal Regulation D, which limited certain types of withdrawals and transfers to 6 per month. Exceeding this could incur fees. While this regulation was suspended in 2020 due to the global pandemic, some have continued this charge. This is because savings accounts are not meant for frequent transactions. To avoid these fees, use your checking account for regular transactions and keep the savings account for what it's meant for, saving. Also, regularly monitoring your account activity can help you stay within the transaction limits. Number 8. ATM Fees. Using an ATM outside your bank's network can result in fees charged by your bank, the ATM owner, or both. These fees might seem small per transaction, but they add up. For instance, the average ATM surcharge in the US was over $4 in 2023, according to Bankrate. To avoid these fees, plan ahead. Use your bank's ATM or consider getting cash back during a purchase at a retail store, which usually doesn't incur a fee. Additionally, some banks offer accounts with ATM fee rebates or a larger network of fee-free ATMs, so consider these options when choosing your bank. And of course, there's the option of not using cash at all, by relying on a debit or credit card for purchases. Number 9. Credit card annual fees. Many credit cards come with annual fees, which can be a nasty surprise if you're not expecting them. These fees are charged for the benefits associated with the card, like rewards points or travel perks. However, banks often rely on consumers not using these perks to their fullest, or forgetting about the fee after the first year or two, when it's often waived as an enticement to sign up for the card. To avoid this, scrutinize the card's benefits versus its annual fee. If you're not using the rewards enough to justify the cost, consider switching to a no annual fee card. Moreover, some banks are willing to waive the fee if you call and express your concerns, especially if you're a loyal customer or spend a significant amount each year. Number 10. Check reorder fees. When you run out of checks, many banks automatically reorder them for you, and the fees for this service can be exorbitant. This often overlooked detail can be an unnecessary expense, especially nowadays where check usage is rapidly declining. To dodge this, opt out of automatic check reordering and buy checks independently if you still need them. Third-party vendors often offer checks at a fraction of the cost banks charge. Also, consider if you truly need checks. Many transactions can be handled electronically. And of course, there's also the debit or credit card option that we talked about earlier. Number 11. Account closure fees. Some banks charge a fee for closing an account, particularly if it's closed soon after opening. This is a tactic to discourage short-term accounts, which are less profitable for banks. However, this can catch you off guard if you opened an account for a specific short-term purpose, or weren't satisfied with the service. The best defense is to ask about closure fees before opening an account. If you already have an account and want to close it, check if there's a period after which the closure fee is waived. Sometimes, maintaining the account for a few extra months can save you from this fee. Number 12. Adjustable rate loans and mortgages. Adjustable rate loans and mortgages offer initially lower interest rates, but the rate can change over time, often increasing. While the impact of this can be negligible in a falling rate market, it's a different story when rates are stable or increasing. As your loan interest rate ratchets up, your repayments can increase significantly. Before jumping in, understand the frequency of rate adjustments and caps on how high the rate can go. Consider how changes in your monthly payments might impact your budget. If you're risk-averse or plan to stay in your home for a long time, a fixed-rate mortgage might be a safer bet. Check out these videos next on other great ways to save money.